Well, so I just shot out the recording, so we're all being recorded so everyone's aware. Um, so I guess the easiest way to do this is if you guys want to just shoot me questions in the chat about anything that you guys might have. I know you've all seen the marketing materials. I know you've seen my previous webinar, so I don't want to bore you by going through our history again, but I'm happy to be as transparent as you guys need in order to make you guys feel comfortable in your decision to either invest or whatever it is you'd like to do.
Hey, Emily, this is George. I think it would be beneficial for the team here. There's a bunch of new folks to just get an overview on Sage, the value proposition and the model you guys are deploying here.
Absolutely. Okay, so high level, Sage buys 1 to 2 star motels. So those are pretty rough. And we convert them into studio housing, workforce specifically. So it's attainable is another word you'll hear. So it's not affordable. That is where there's like government subsidies and whatnot. We are attainable housing. So we're for the workforce, that missing middle, like I mentioned. And so we provide studio housing for that market specifically. We target areas that are in growing, emerging B-class markets that are next to workforce centers, as well as large amounts of either metro, train, or just bus lines. So that way we're able to really like provide a lot of value to our tenants. So we specialize in doing that. We do the BRRRR model at large scale. So we purchase them off market, we revitalize them, we rezone them, we reposition them. Within about 18 to 24 months, we're able to get them fully stabilized and tenanted. At that point, we trigger a cash out refinance. We take all of our cash out, we buy another property with that cash. From there, we hold that original property for anywhere from, in the case of these hotel conversions, it's another 18 to 20 months. So somewhere around years 3 and 4, we sell the property at its peak ROI. For us, that allows us to provide a return that's pretty exceptional. It's about 2x in a 3-year period. So if we're able to take our investors' money and do that 2 times in that 5-year hold period, that's how we're able to provide that return of a 3x return at the end of 5 years. It's a really wonderful little niche that we have found. Not only does it have a massive return for our investors, but it revitalizes an underutilized asset, which is much better for the environment than building new. It allows us to bring much in demand housing to market with anywhere from 8 to 10 months versus building from scratch, which can take up to 5 years. It allows us to provide safe, affordable housing for a portion of the tree that where it just desperately needs. So it's really a win-win. Like I mentioned, if anybody heard it, also because we are taking an asset where there's a lot of transient, a lot of crime, it allows us to also massively reduce crime in our communities and be able to provide all of the, amazing benefits. So that's a high level what Sage does. There's a few more people in the waiting room. Kind of high level of how we're able to provide our returns and what our little niche is. We've been doing this since 2019 when we bought our first hotel conversion. It was in Tucson, Arizona, and it was being run as a hotel at the time. And we were able to get that revitalized and turned into workforce studio housing. And that's kind of how we learned that, oh my goodness, this little niche is gold mined and it's massively in demand. We, as many people ask, yes, we were concerned that studio housing is a little bit of a niche and that not everybody would want it. But because studio housing generally in the United States was only zoned in large metro areas such as New York, Chicago, LA, these secondary metropolitan areas really have a huge demand for it. For example, Tucson is a secondary metro area. Everybody thinks, Phoenix. Tucson is a large emerging city. We see the same thing here in Seattle. We don't buy in Seattle, we buy in Tacoma. Second largest city in the state, still desperately needs it, was never zoned. So those we look for those secondary cities that never were zoned for this type of housing, and we really go after them. And so we've found really great success. Our property that came online, it's actually grand opening ribbon cutting is tonight. So that's why Ross wasn't able to be with us. He's downstairs or down south cutting the ribbon. It has only been open and available for tenants for 3 weeks, and we're already at 75% occupied, which is amazing. We didn't think we'd be at this level of occupancy for at least 6 months. So there's a huge demand. Okay. Can we talk about South Carolina, Columbia 129, and Columbia 138. Why those areas specifically? So as I mentioned, Columbia is a great secondary city. It's a booming population. There's a lot of development going on in the southeast, specifically of this part of the country. So it's one of those areas where we're seeing a lot of development and there's a lot of demand for studio housing. And the state of South Carolina is open to these conversions. One of the big issues that we have run in across the country is we have to find MSAs that meet all of our criteria of what we're looking for, an emerging B-class market where there's a lot of growth, a lot of job community, a lot of job development, but also states specifically that are open to these zoning changes. So we're finding that North and South Carolina, Florida, Tennessee, Washington State, are all really open to these zoning changes. So specifically targeting those states where we know we can go in, because we have absolutely no interest in running a hotel. That's not what we're doing. We will not buy a property until we know and actually have in hand the rezone certificate from the state or the city. So that's why we're targeting South Carolina and the Columbia specifically. Let's see. Since rezoning is vital for the investment to succeed, have you ever had any issues getting the property rezoned? Like I mentioned, we will not purchase them until we have rezone in hand. It's not a risk we're willing to take. Some of our competitors will do that, especially if they do also operate hotels. That is not something that we will do. So we will not buy them until they're rezoned. And our lenders won't even lend on them until they're rezoned. So it's too multifaceted. We won't do it personally, and our lenders won't allow for it. Okay, I'm sorry. I'm always terrible at reading and not looking like a weird owl. With the BRRRR model, most people have concerns about interest rates, and can you comment on the risk mitigation for increasing interest rates? Yes, absolutely. That is honestly the biggest risk factor in our business model. Hands down, people say, what's your number one risk? Interest rates. I was super thrilled yesterday when the CPI came out. It looks like we have slowed down from our 40-year record increasing high. So that came out yesterday at 3%, which is wonderful. But with that, there are ways that they fluctuate the CPI and other indexes that the Fed looks at too. So with that in mind, we completely skyrocket how we underwrite properties. So we underwrite them thinking that we'll get a 12% interest rate on them. To make sure that the numbers work, right now we're currently getting about an 8 to a 9%, depending on who our lender is and what bank source we're using. But yeah, that's how we account for it, is ensuring that we way overestimate our interest rates. So that's how we compensate for that. And then also, are you handling the increase in construction costs? Okay, so this one's fun to me because I really love that we were able to call on our family of investors. So we've got a bunch of different investors that have helped us out in order to make sure that we're still able to do this, because one of the ways that Sage is very unique is that we have very, very affordable contracting costs. And that's how we're able to really, make such a huge splash with our returns. So we've done it in a couple ways. One, our third largest investor is also our largest contractor. So he is highly motivated to ensure that our margins are tight and that he is on time and that he is on budget, because it's not about him trying to nickel and dime us, because his money, to the tune of millions, is invested in Sage. So he really wants to make sure we succeed. So making sure that our contractor and Sage values are aligning is vital. So that is great. The other way that we're able to do it is we work with some of our investors who have connections in India and China, and we bring over goods directly in a large scale, freighted over directly without using any middlemen. We go straight to the factories in China and India, negotiate the deals, and send them over. Recently, I just purchased 170 toilets, and they're sitting in a warehouse outside of one of our properties currently. That scale and that guaranteed of goods allows me to continue to keep everything on time and on budget. So that's how we're able to do a lot of that. Toilets, we buy plug and play kitchens, we buy LVP, which is flooring, we buy our torch down roofs. All of that comes in containers straight from manufacturers in China and India. And we have wonderful investors that have taken the time to be boots on the ground in those countries, ensuring that we're going to get the quality, the timeliness, and that we're not getting ripped off. So that's how we're able to do that. So that is a huge thing. Next question. Does Sage work with housing development authorities to evaluate for demand of this asset type? So we generally don't start that way. We have different other metrics that we use, but what we do work with the housing development authorities on is in a large times they want to be our potential buyers. So housing authorities are very limited in what kind of development they can do, what kind of construction they can do, and what they're allowed to purchase. So for them, it's much simpler if somebody like us comes in and revitalizes the asset and they're able to buy it directly from us. And not have to deal with what they would have to go through in terms of the state regulations, the city regulations, or that municipality's regulations. So generally, we work with them on the back end as a buyer, not so much on the front end to evaluate the area. We have different other, private metrics and services that we use for due diligence to ensure that we are coming in and that there's enough demand for what we're purchasing. Okay. Do you have a list of properties in the fund and how each property is performing in terms of cash flow and if it's contributing to the quarterly dividend? Has the fund met each dividend? Has the fund met each dividend each quarter? And what criteria do you use when making decisions to sell a property? Okay, well, that's a whole host of questions, so I'm going to break that down a little bit. Yes, we have a list of all the properties in our fund. And I can absolutely provide everybody with the fund's overall balance sheet and P&L. I believe that we've already provided that information to Kenji. I'm sure that he'll be happy to send that out to everybody. We do manage the fund as a whole versus individual properties because generally, based off our model at any given time, almost 50% of our properties will be massively losing money because they're in the middle of redevelopment. When we buy these properties, they're vacant. They are gross, they are smelly, and they are crime ridden. So they just absolutely bleed money for the first 12 months, to be perfectly honest. So the individual property performance is a little bit hard and will be a little scary depending on which property you're looking at, given its position in redevelopment. We do have plans for them. We account for that. We have cash flow buffers that are, cash flow reserves that are specifically set aside for that burn period. But that's what the beauty of the board, the portfolio of the whole as a whole is versus just investing in one individual property. The rest of the portfolio that's already fully stabilized is able to compensate and allow for the dividends. The question about the quarterly dividends, I think that you're saying is, have we ever missed one? And the answer is no. From the inception of the fund, we have like clockwork done a distribution the month following the quarter close with no exceptions. It's something we're really proud of. The largest distribution we've ever done was 16%, and the smallest we've ever done is 6%. Right now, this year, we're doing a 6% distribution based off of the current share price. But when you break that out across all of our investors and you account for the fact that some investors came in at a much lower share price, that distribution means that depending on when you invested, it's anywhere from a 10.2% distribution to a 6% distribution. So as we continue to increase our share price, that 6% baseline that we have promised, it's not preferred, we have promised handshake deal to not go below, will increase automatically. So next year when we increase our share price, that 6% will go up. It will stay steady at 6%, but the share price will also go up. We're also hoping that as we come out of this tight interest rate market and things start to relax a little bit, that we'll be able to get back up to our preferred anywhere from 8 to 10% distribution. That's where we'd like to see. We're being really conservative right now because the Fed still hasn't said they're going to knock off with interest rate hikes. So we like to keep cash reserves on hand right now, just in case. We'd rather be in the position to ride it out and sit back on our reserves than some of our competitors that have had to do fire sales, which honestly has been kind of nice because we've been able to take advantage of those fire sales and buy some great assets, but we don't want to be in the other position where we're having to sell. So with that, we're being really conservative. And then the final question in that series of questions was, what evaluation do we use to when we're going to sell? So for us, it's all based off the numbers. So we sit down at the beginning, there's a massive analysis template that I believe Kenji can also share with all of you guys. I send it to him. If not, I can resend it. And it shows the breakdown of how we analyze a deal. And with that, it forecasts all the way out for the next 10 years what the property, its ROI is going to be. At a certain point, we hit a peak ROI where we have so much equity in the property we can't tap that the ROI actually starts to go down. So with that, we generally sell, our goal is to always sell at that peak ROI. Of course, market conditions will factor into that. We aren't selling very much this year simply because, cap rates have, they're not where we want them to be. So with that in mind, we generally, for these hotel conversions, as a general rule of thumb, that's right around year 3 is when those sales happen. Sorry, we have people in the waiting room. I am sorry about that. The greatest multitasker this evening. I apologize, everyone. Thank you those for joining. Let me get back to my questions. I wish that I could have both up at the same time and not ignore the waiting room. I apologize if you've answered this, but have you managed similar funds before this fund? The fund performed as modeled. So prior to this fund, we actually did individual syndications, which was great. I loved doing individual syndications. My reason for why we switched over to this fund model that was brought to us by our legal team that we worked with for our syndications, they said, hey, there's a fund model you guys might want to explore, was because we had different syndications going and some of them did better than others, right? So depending on which syndication you were in on, it depended on your returns. Now, we have never lost an investor money, which is something I'm very proud of, but some of them were getting like a 35, 37% return, and some of them were getting a 20% return. So with that, even though 20% is awesome, they were pissed they weren't in the other one. And so we had investors that were like, no, I want to wait for the good one, or it was just creating a lot of, hard challenges. And we couldn't offer distributions right away. We had to get the property up and stabilized. And depending on the timeline, that took a lot of time as well. So when this model for this fund was brought to us, where essentially we just bring them all into one and the funds can balance, or the different properties can balance each other. And so that way it's fair to all of our investors. It's even across the board. We thought that this made a lot more sense and it helps diversify a lot of the risk that we were concerned about. We bought student housing in 2019. And that was like an earth-shattering thing for us. I don't know if anybody thought what was going to happen in 2020 was going to happen. There was no one that could predict that, right? So owning student housing in 2020 when there was no students was terrifying. And we had to shift gears and make that happen. In the process, we were losing 50 grand a month. And that was incredibly stressful. And so now with the properties being in a fund together, we're able to know that like, okay, they can balance each other while we shift gears, and we don't have to have such, massive reserves. We can have those economies of scale and be able to mitigate that risk across a portfolio. And so that's how we led to this fund model. But no, to answer your question, I've not managed a fund like this before. In slide 15 of your deck, how do you come up with the current value? I'm assuming page 15, I'm sorry, I don't have the numbers memorized, is the overall what each is the list of our portfolio and what they're currently worth. The current value is based off of third-party assessments that are done at either each year. We do it once a year when we evaluate our share price. And then we also do it whenever we have a refinance or a sale. So that's how that current value is come up with. It's done by a third-party appraiser. Okay, let me see if I've missed any of this. Do I have, well, hang on, I've got one more person in the waiting room. I'm terrible. Hi, Cliff. Welcome to the meeting. I hope you weren't in there long. I'm sorry. I'm trying to manage this all. What interest rates are on the properties and what types of loan, aka interest only? So this is an interesting question. We have a full-time staff member that does nothing but manage our loans. He keeps track of everything because every loan is different and it depends on where the property is, what's going on. Our source of lending is different credit unions around the country. We like local credit unions tend to be what really, is based off the size of our fund that tends to align the best with what we're looking for. So we have a lot of automatic construction arms that roll into fixed rate terms. Sometimes we just have construction arms and then we'll refinance out of those. They're all different. Right now, we have a 63% loan to value as a fund. So very, very healthy. The terms range. Some of them were locked in. we have some very beautiful interest rates that are locked in that are, you know, down in the threes. So we love those. The highest I believe we currently have right now is a construction arm that's sitting at 12%, which is high, but not astronomical. And then of course will come down once we're repositioned and restabilized. During the repositioning period, Ross and I personally guarantee those loans in order to be able to keep the interest rates within reason, because while 130 million is a lot of assets under management, it's still not enough for the banks because of how risky these things are while we're under reposition. So Ross and I personally have to guarantee them. So that's a little fun fact about the interest rates there. Is it possible to invest with a 401k? Yes. If you invest directly into Sage, I do not know the question if you go through Kenji's fund of funds. I don't know, you'll have to ask Kenji, but if you invest directly within Sage, if you move your retirement accounts to an SDIRA or a self-directed 401k, you can invest through those. I do not hold a Series 7. All I can tell you is that I'm seeing a lot of investors invest with us and how they do it. Something to ask your a Series 7 professional would be if it makes sense for you to currently blow up your 401ks. The newest trend we're seeing of all of our investors is they're blowing up their retirement accounts. Right now, there's a lot of sense in the math to eliminate them. So that might be something you want to explore as well, since some of those are down and now the percentage makes sense. Again, I do not hold a Series 7. I'm not giving you financial advice. Simply ask, as I'm seeing that as a trend with my investors and how they're investing. I'm seeing a lot of people completely blowing up their retirement accounts. I'm seeing a lot of S blocks, which are security backed line of credit, very similar to like what a HELOC or we see on a home, that kind of idea. And then the other big one we're seeing right now is whole life insurance policies, like crazy. Those are being utilized by our really savvy investors that are trying to, double down and have some leverage there. So those are all things that I would love for you guys all to explore. I am a huge believer in really educating yourself on finance and investment strategy in this country. In the 70s, it used to be that 41% of Americans were considered financially literate. The newest stat that came out is that only 11% of Americans are considered financially literate. That is horrifying to me. So I want all of us to be able to make money and reach our goals. I feel like money just brings options, and options just are so wonderful to have as humans. So please use financial planners, find somebody who you can trust. If you don't have a good financial planner, please reach out to me. I'm happy to give you some names. I have a few that are really great, including the one I use personally. Okay, sorry, that was my tangent. I'm passionate about it. I can't help it. Some more guests in the lobby. Thank you guys. Why can't it tell me this? Okay, they've been in. Let's see, back into my questions. Okay, love this one. Would Sage ever ask for more money from an investor if cash flow became negative? It is against our contracts to be able to do that. That was something that was very important to me. It was what I hated the most, that whenever we were offered an investment in a syndication, is that you had this like looming threat of, well, I'm investing and I have no say in how it's being managed. There could be a capital call at any given time, and I would have no say over that. So that was something that I wanted written very clearly into our contracts, that you're only on the hook for the money that you sign up for. So if you invest 50,000 with us or 100,000 with us, that's all that's at risk. I cannot come to you asking for more money. If negative cash flow were to happen at Sage, then I, myself personally, my husband and our other business partner, Casey Stratton, have to cover that loss. With that, we keep a very, very large amount of liquidity between the three of us in order to account for if anything were to happen. We do that in the forms of lines of credit. So that way we're able to cover anything that should arise. But that's something that personally we have to cover because we do not want to have capital calls as part of our contract for Sage. How do you mitigate the risk of equity dilution? This is a great question. So we do that with our share price. So every year we sit down and have a third party, it happens in October, come in and evaluate each property's value. Based off of the current value of the property, and what the current values of the property were last year, we know what our equity is for that has increased over the year. That's a direct reflection of how we increase our share price. So when we first started the fund, the share price was really simple. It was $1 per share. Then the following year, we raised it to $1.37 per share based off the increased equity in the fund. This year, we were very conservative because of what was going on with cap rates. So we only increased it to $1.43. Come October, we'll have the entire fund reevaluated, and based off of that third-party evaluation, we'll increase the share price for 2024. That's how we were able to reduce the risk for any dilution from new oncoming investors. Let's see. Bobby. Okay, thank you guys for joining. So let's see, what is another question? I've looked at your quick presentation and see a 5-year mini pro forma. Will the fund end then, or do we exit individually? Has it already started? Okay, this is a wonderful question. So if you invest directly with Sage, if you go through the EB Pro fund that Kenji has established, it might look a little different. I don't have any control over that fund. I can only tell you about Sage. So the way that it works is every year we're a continuously running fund. So if you invest in 2023 directly into Sage, then 5 years from now, you'll have your sunset. It has not already started. It's 5 years, starting over every year. In those 5 years, like year 4-ish, I'll reach out and say, hey, you're coming up on the end of your fund, on the end of your term. Would you like to continue to stay within the fund, receive distributions, and have your equity multiplier increase? Or would you like to be liquidated? That'll give you the option to be able to do that. At the time of liquidation, you will have a capital gains tax event. Some of that will be mitigated by our negative K1s for our accelerated depreciation that we do pass on to our investors. But I'm sorry, I'm going to make you too much money. You're still going to have cap gains. So do know that when you do liquidate, you're going to have to figure out what to do with that tax event. So there is that to consider with that, but you will be given the option if you want to stay within the fund. The only way that that wouldn't be the case is if we were bought out as a whole by a much larger equity fund, which does tend to happen. But if that were to happen, the only way I would agree to that is if I was going to be able to blow what I thought we were going to be able to ride our investors completely out of the water. So in that case, we would all make just buckets of money. So that would be the only time where I would see that strategy might change. Oh, I have one more person in my letting in. Oh, raise their hand. Sim, do you have a question?
Yeah, so for some reason, I don't know how to send a message. And so I've been trying for the last 40 minutes to figure out where this messaging thing is. And so it just...
Normally I do it through Zoom in a webinar. Well, this is an Audible.
Oh, no worries. So I just have a question. So if we take cash that we have, or from a brokerage account or otherwise, it's not from our retirement account, and we send it to you guys, are you guys able to create an LLC, or are you guys able to create something that provides a little bit more of asset protection from the standpoint that if we as physicians were to find ourselves in a precarious position from our work, that would be protected, that money would be protected?
That's a question that you're going to ask a lawyer. Now you can invest with us via different vehicles. So you could create an LLC, you could create a trust, and then invest via that. I, on my end, I can't like hide the cash for you.
No. That's not what I was asking. It was just more so as far as, do we need to create our own LLC first and then put the money through there and then send it to you? Okay,
yeah, that would be the best way to do it. Honestly, I will say, consider a trust. One of the things to know when investing in real estate is that if you invest in real estate that's out of the state that you live in, it automatically will trigger a probate event unless it is in a trust. So that's something to consider. Again, I'm not a Series 7. I'm not an estate planner, but having learned this the hard way with a few of our investors, that is something to consider. So talking to a tax professional, CPA, Series 7 about how to set that up strategically the best way. Consider a trust. I know everybody thinks they're for super rich, old, wealthy white dudes, but they are really powerful vehicles, and there's a lot of ways to utilize them. I have seen some really savvy investors do some really cool stuff with them for not that much money to get them set up initially. So I would consider that.
Okay, thank you.
Of course. Does this investment qualify? Buckets of money are good. My son likes that phrase. I don't, so I've picked it up. Does this investment qualify for a 1031 exchange at the time of equity sale or liquidation? Unfortunately, it does not. We do utilize 1031s within the fund when we buy new properties, but there's no way to 1031 out of the fund into another fund. It does not work based off of the way that we carry our Series 7 license. Unfortunately, you will have a capital gains effect, a capital gains triggering event when you liquidate. Now, I will say, if you really want to get nerdy, there's a whole host of CPAs that do not believe in 1031s. It is an interesting thing to Google why you should not 1031. There is a pretty good argument for why you should pay your taxes now. I still utilize them, but it is something interesting to read about if you want to be a tax nerd. Okay. Are your property valuations performed by independent auditors? Yes, we use third-party independent auditors that we have no say over. That is how we're able to, one of the factors that we're able to, be honest and keep ourselves accountable. There are a host of reasons why we do that, mostly because there have been funds in the past. There was a huge scandal in the 80s where a fund didn't do it and they were doing in-house evaluations and they were completely padding their numbers and they were taking fees off padded numbers. We don't take fees off of the evaluation of our properties. We don't take like an equity fee, so that becomes less of a conflict of interest. But still, we like to have as many different just honesty checks as we possibly can. Private equity, there's no FDIC insurance on it. There's no guarantees. It's 100% risk of loss. I'm not going to sit here and say, you guys can, you can trust me and this is why. There isn't a lot of that in private equity. You always are making a little bit of a leap. So with that, we like to do as many things as we can at Sage to be able to make you guys feel comfortable that we are on the up and up and that we're being transparent. We use PwC, which is one of the big four. It's one of the largest accounting firms in the world to do our taxes. Once we get a little bit bigger, we'll start having them do independent audits. Right now, it's just not cost effective for us. It's very, very expensive to have them audit our books. That's something that we will be starting as soon as we can justify it and afford it. The other thing that we do is we have third-party appraisers of all of our properties every year so that you guys can have that information. And the big third one that I hope brings you guys some form of comfort is that my husband and I personally, with our personal money, buy in as LPs every year to the tune of $1 million. And we are currently the largest shareholders in Sage as LPs. So whatever happens to your money really happens to my money as well. 90% of our personal worth is in Sage. The only reason we have 10% out is because we need that liquidity in case something happens and we have to fund Sage. So all of my eggs are in the Sage basket. So those are the things that I can say to you guys to help you understand that, yes, this is 100% risk of loss, but this is why I will work to the absolute death to ensure that we have the best outcome possible. Are there any fees assessed? Yes, we take a 2% of gross rents every month, every quarter. This is kind of a minimal thing, to be perfectly honest, because at any given time, 50% of our portfolio doesn't have any tenants because it's under repositioning. The other fee that we take is we take a 4% acquisition fee. Every time we purchase a property, we take 4% of that purchase price. So depending on the size of the property, that's anywhere from 100,000 to about 700,000, given our current scope of what we're buying. That fee is used to help us oversee the repositioning. It is very labor intensive for us to be able to manage and oversee the repositioning of these assets. Where we actually make our money and our profit comes in is with our waterfall. So we have a 70-30 profit split once LPs have been made whole. So we buy a property for, easy math, $5 million. We use investor funds to bring in that down payment. We 3 years later turn around and sell the property for $15 million. 5 million of it, of course, we have to pay off everything, including our LPs. So we have 10 million profit. 7 million of that goes to our investors and gets split amongst all of our LPs. The other 3 million is kept by the fund managers as our profit for our efforts. So that's how our fee structure works. Let me see. Sorry, they're coming in pretty quick. If you invest now and reinvest later, are you locked into the original share invest or the original investment share? No. Well, it depends. So every year we only change our share price once a year. So if you invest now and then invest in December, it will be the same investment share price. But if you invest now and then invest next year, your investment will come in at the next year's share price. We do not allow anybody to be grandfathered in. I do not grandfather myself in, and I have not even grandfathered my own mother in, even though she is asked. Everybody pays the current year share price, regardless of who they are. So we have to make sure, otherwise we have dilution, and we're just not going to dilute people's investment. What is the timeline for the Columbia 138 deal? I can't wait to sit back and collect money. When do we get our first distribution? Hee hee. Absolutely. So the timeline is we're closing on the Columbia 138 deal at the end of the month. So we're hoping to have all of our funds in by the 21st would be ideal. You'll start collecting your buckets of money the day your wire hits. We prorate that first quarter's distribution. So if you guys invest before the 21st, you'll receive your first distribution right before Halloween. If you invest directly into Sage, it comes out the last Tuesday of the month following the quarter close. If you invest via Kenji's fund, then it will come out a few days later just because he has to turn it around. So that is how that one works. Let me try and sneak in a few more of these questions. Do you have a pipeline of new properties? Oh my gosh, we have so many good ones. I'm so excited about what Q4 is going to bring. So we've got this fantastic property on a lake. It's beautiful. In Olympia, Washington. Olympia is the capital city of Washington. It's gorgeous. It's 158 units. That one's beautiful. We're really excited about what that one can do. There's a property in Houston, first time coming into Texas, that we're really excited about. There's a property in Denver that my inspector told me was the most disgusting building he's ever seen. And he for sure thought he was going to find a body, which just for me smells like money, because the nastier they are, the better it is. So we're really excited about that one. We're negotiating really hard on that. We did not find a body, just FYI. So there's that property. And then there is one in Chattanooga that we've continued to circle around. And then a couple in Orlando, which I'm excited about because, Disney World. So we are all over the country. We have 11 acquisition specialists surrounding the country that work tirelessly trying to bring us all the properties that we can. To be honest, right now, it is less about the properties and more about me bringing in enough money to be able to buy everything that we can find. There's so many great deals out right now. There's about 70,000 underutilized 1- and 2-star motels across the country. So there's a lot of things out there to be picked up and bought. Let's see. What is the biggest challenge you see for your fund? The biggest challenge right now, to be perfectly honest, is interest rates. It's less about how high they're going to get and more just about knowing what they're going to be so that we can plan for it. If we can plan for them and know what they're going to be and be able to lock them in, then we can just build our budgets and our due diligence around that. It gets really challenging when we don't know, and the unknown is really hard. So I'm hoping that the Fed has their announcement. I believe it's on the 25th and the 26th, they're meeting. So hopefully on the 26th, we'll know kind of what they're thinking for the rest of the year. But to be perfectly honest, I don't always trust them and not going back on what they're doing. So just having a little bit more idea as we come out of this is different recession. I am very hopeful because inflation is down and unemployment is so incredibly low that that's just such great indicators for our country. So hopefully we'll be able to get a little bit more stabilization. Let's see. I think I got everything in the chat. Let's see. Last question. Will you have exposure to the entire fund? Yes. That is the best thing, is that, yes, we're currently raising for Columbia 138. So we only bring in, we need body, sorry. Somebody in the chat's making me giggle. It's hard to focus. Yes, we're currently raising money for Columbia 138. We only bring on new funds when we need new funds. Otherwise, why would I raise money? But when you invest within Sage, you get invested in all the past, present, and future properties. So with that, we're buying about 100 to 150 million in assets each year. We're doing massive remodels on those. So the best part about it for me with that constant buying is that as an investor, there will be plenty of depreciation to be spread amongst all of our LPs. So as long as you have an active capital account with Sage, you can expect to receive a negative K1 because not only do we have buckets of money, but we have buckets of depreciation that we like to share. So I do not have any bodies though. Last question in the chat. Sorry. Someday I'm going to write a book and tell the truth about all the crazy stories that I don't tell people. But there's some wild things that happen here in Sage. I will say this last little funny thing, if anybody has time, is we recently took over a hotel in Centralia, Washington, which for anyone familiar with the area is about an hour and a half outside of Seattle, south. And there was a handful of residents there. And we're like, well, this is odd. There should be no one here. So we have a great community relations investor or great community relations manager. So she's down there, she's talking to everybody, trying to figure out how we can help these people and what their story is. And she calls me, she's like, Emily, there's this old couple down here and they seem malnourished and super confused. I'm like, well, that's really odd. Like, give the Salvation Army a call and let's get them some help. And she's like, okay, well, I'm going to take them for lunch and I'll get some help. And so sure enough, the Salvation Army shows up and they figure out that this couple is under under a silver alert and they have been missing from their daughter's home for 4 weeks. And they have dementia and they just started driving and they drove for 3 hours until they got lost and pulled over and were staying at this hotel and they had been there for a month. And so it was wonderful. We were able to get her, we called their daughter. She was like, I will be there in 4 hours. Like, please keep them. So meanwhile, we had lunch at IHOP. It was fantastic. And they were so embarrassed. And it was just a great day where it was like, wow, we really did help some people. But there are some really crazy stories out there with these really quirky properties that someday I will write a book. But yeah, that happened to us recently. It was really wild. So. Okay, you guys. James, please feel free to share my information with everybody. Feel free to reach out and ask me any questions that weren't answered. It was wonderful talking to you all and letting you guys listen to me rant on. I am a huge, like I said, this is my baby, in addition to my 3 babies. So I couldn't be more excited about what we're doing at Sage. Like I said, it really is heartwarming for me to be able to provide all of our investors fantastic returns, give them the options that independent wealth can really create for a human, but also be able to do good things for our community, give back, and be able to provide quality workforce housing for people that really need it. Okay, well, thank you guys. I will send out this recording to James. I'll forward it to you and you can forward it on to everybody else.
Yeah, thank you for everything, and thanks for your help for the last minute issues we had. But thanks for everybody for joining as well.
Okay.
Bye, Emily.
Oh.